going on, everyone? Lalit here. Today, we'll be talking about how credit card companies make their money and how it could be affecting you and your wallet. There are quite a few ways in which credit card companies make their money, so by the end of this video, you may want to call your credit card issuer and have a little chat with them. But with that, we'll get it started off, and I'll start with the most obvious one, interest charges. Talking about interest and interest charges, whenever you see an APR, basically that's the interest rate for the year. But what they don't say is that actually interest is compounded daily. And so by the end of the year, you're not really paying this X percentage. You're paying a lot more. And that's why credit card companies make a lot of money through interest charges. In some cases, you have straightforward interest rate where there's just one interest rate regardless of your credit score. And then depending on your credit score, there could be tiered interest rates. Talking about tiered interest rates, you have the Venmo credit card, for example, and it looks like this, where your interest rate is different depending on your credit score. The Venmo credit card is issued by Synchrony Bank. Although this isn't the case with the Venmo credit card, there are other cards under the Synchrony Bank umbrella which get a bad rep because there are offers, for example, when you open a new credit card of, hey, you get 0% for 12 months, but if you don't pay your balance in full after the 12 months, all of that interest gets rolled up from day one for the whole 12 months and it'll be payable on that actual period right after the 12 months. So if you had a $1,000 balance and you pay $999.99, just have a penny left over from paying over that full balance, you'll get interest charged on that initial $1,000 as if it happened for the whole year. Interest payments can wreck any individual because math is math, compound interest is compound interest. Credit card companies get richer and the average consumer gets poorer. And so what I would say is pay in full, pay on time. It doesn't just help not paying interest, but more importantly, it helps your foundation to have good credit for the short term and the long term. With that, we'll move on to the second way credit card companies make their money, and it's through fees. Credit card companies charge a boatload of fees, and if you're not aware of them, they could actually eat at you really, really badly. So, starting off, you have an annual fee. Annual fees are usually charged yearly. They could be worth it. It just depends on if you're getting more expected value than what you're paying in terms of that annual fee. On the other hand, you have balance transfer fees. Balance transfer fees are not actually a bad fee. They could be used as a tool to save you from paying even more interest in the first place by balance transferring some debt to another, let's say, card or another way. And so that balance transfer fee, usually which ranges from 3 to 5%, could be worth it instead of paying, let's say, 25 upwards to 30% in interest over a year by staying with your current credit card issuer. Further, if you look at the X1 credit card, they have a balance transfer fee of 2%. Typically they're 3 to 5%, but for example, with 2%, it could be a better deal to maybe balance transfer with that type of credit card. Also, there's other credit cards that have some promotional offers like 0% balance transfer fee up to 15 months in addition to 0% APR. So for example, if you have $10,000 of debt and you transfer it onto this type of promotional offer, you wouldn't pay any interest for the first, let's say, 15 months, and in those 15 months, no interest would accrue as well. You have late payment fees. This is obvious, but basically don't pay your bill late. And I can understand that it happens if you don't have auto pay on, so have auto pay on to avoid this. But if you don't have cash in your account and it would be late anyhow, then maybe try to make an arrangement with your credit card issuer saying, hey, XYZ, this is the case, and maybe, just maybe, something could be worked out. This is the one thing you shouldn't be doing with a credit card, and it's taking cash out of your credit line, because you'll be hit with cash advance fees. If you go to ATM, for example, and you use your credit card and you try to take out some money, basically that's where you'll be incurring these cash advance fees because you're taking directly cash from your credit line. If you look at your statement or your credit limits in general, there's a purchase limit, kind of the credit limit in general. If someone says, oh, I have a $10,000 limit, that's usually how much they can purchase with the card. But if you look at a cash advance limit, it's usually far, far less. One tip with cash advances is you may want to call your credit card company to make that limit as low as it needs to be or can be, because if you take even a penny from your credit line, instead of the statement closing and then interest starting to accrue, it accrues from literally that day. The next day, you'll be starting to hit interest in real time and it can add up super duper quick. More than that, with cash advances, what I didn't know is I did one cash advance, just one, and I didn't even know that it would be classified as a cash advance. I was sending money through MoneyGram. In hindsight, of course, it sounds obvious, like, dude, you're sending cash online with your credit card. So it's technically, or basically, a cash advance. But the reality is that basically when I called up Chase to be reconsidered for the Hyatt credit card, for which I was denied initially because I was above 524 and I didn't know, and this was a long time ago. But the point is not knowing this and basically asking for, hey, I have good credit, I have a good relationship, everything looks solid on my credit report. But that one cash advance affected me because they called me out on it saying, hey, why'd you do this? And obviously I just said the truth. I said, I didn't know about it, but that doesn't fly, I guess, with them or the underwriter or in general. Cash advances are a big no-no for credit card issuers because I guess taking cash out directly from your line instead of purchasing something and then paying interest on it, I guess it's a no-go for them. For credit card issuers, I can understand to some degree where, yeah, there's a flight risk, it's called, where you can basically take all the cash out from your credit line and just disappear. Sure, so that's a risk for them. But the point is, when we know that there are these cash advance fees and we can avoid them and just not deal with them, I think that's better than not. Emergencies happen and that's totally understandable. There could be other ways, but this is just a huge disclaimer that I just want to put out there because I learned a lesson the hard way, and so yeah. Next, you have foreign transaction fees. Some cards give you no foreign transaction fees, and that's really popular with travel credit cards. But on the other hand, these foreign transaction fees kind of range closer to that, around 3%. And so if you're abroad and you're spending, you'll not only be hit with the foreign transaction fee, but more importantly, you'll already be hitting this conversion fee. So for example, if I'm going to Mexico and I spend $1 equivalent in Mexican pesos, what's going to happen is I'll be hitting the conversion charge, which won't be ideal in my favor. I've seen it from experience. And further, you have the foreign transaction fee, which is this, around 3% on top of whatever you're already spending, which is a fee that's charged by your credit card issuer. Then you have returned payment fees, which is almost like a double whammy because what a return payment is essentially is, let's say I say, hey, I want to pay my credit card for, let's say, $50 payment from my checking account. If, let's say my checking account, just an example, I have $49. If the credit card is trying to be paid off with the $49 on my checking account for a balance of $50, it's not going to go through. And so you have a return payment fee, which is basically saying, hey man, we tried to get this money, but we couldn't. And so for us going through this hassle, we're charging you this fee. Where the double whammy could happen is that, for example, let's say that $49, let's say instead your bank actually lets a transaction go through. And so now your credit card is paid off for that $50 amount. But now in your checking account, you have negative $1. But immediately you're going to be hit with the overdraft fee of, let's say, for example, $39. Now you're going to be negative 40. But now the next day, and I've seen this, and I won't call out any banks, but these banks for the next day and the next day, up to 3 days in a row, they can be charging you that overdraft fee. So you could be hit with that $39 day one, then day two, then day three. Before you know it, you're already negative $100 plus in the hole, and you wouldn't even know it if you're not having alerts on, if you're not aware, or it's just what it is, and it's pretty unfortunate. Overall, these fees are all just like burning cash if you're not on top of it. But again, why do we need to be on top of it? Because we're trying to reap the rewards, reap the miles, the points, and everything. So it's kind of like this game, but if you don't play by the rules in terms of the credit card issuers, then you're on the other side and paying them out the wazoo. Moving on to the next way credit cards make money, merchant fees. Starting with the basics with regard to the flow of a transaction end to end. So first you have your Visa, MasterCard, Discover, Amex, Diners Club, etc. So these folks basically allow the transactions to happen on their network. And so they charge something known as interchange fees. So for every transaction, every swipe, they're getting a piece of the pie. So that's one angle of credit card fees. But in addition, then your bank, your Chase, Bank of America, PNCs of the world, Wells Fargo, etc. These folks also get some piece of that pie as well in terms of fees. Next, you have credit card processors, which, for example, for the Marriott Hotel and Hilton Hotel, not all the hotels, but at least in America, basically Elavon is a company that allows all these credit cards to be processed in their system. And so they also take some percentage of the pie in terms of fees overall. Then you have merchant account providers, for example, Square, where they have their base rate of 2.75% plus 30 cents. But in the end, if you're spending $1 on something to a merchant and you put it on your card, there is that 2.75% plus 30 cents that's being cut away from total kind of revenue in general for the merchant. And so what that really means is you could be overpaying for something because the merchant is almost low-key incentivized to increase their prices to make up for that difference for the fees that are charged by these merchant account providers. Finally on this list, it's not the last of any of the fees that credit cards charge by any means, but you have payment gateway charges. For example, if you use Apple Pay, every time you actually make a transaction, Apple Pay has taken a little piece of that transaction. Finally on this list of how credit card companies make their money, you have selling information. Credit card companies can sell the actual data that they can understand from their consumer base. So, for example, if you're swiping at Starbucks every single day, it's not that they're selling you specifically your personal data one to one, but it's usually batched up in a huge data set of, okay, we have all these people of a certain income bracket, of a certain expenditure, a certain category spend, a certain kind of categorization, which could influence in terms of data and analytics behind it for other companies to target a certain section of the population or credit card consumers a certain way to obviously market to them for more products and get more business overall. It's kind of a scary thing sometimes to many folks that, oh my gosh, they're selling my information. And you can actually limit the amount of information that's shared by calling your issuer, but also look into the terms and you can kind of see like, hey, what can I limit and what can I not limit? And if you're not comfortable with that, then naturally that's a next step that you can take accordingly. So how do all these ways that credit card companies actually affect you and your wallet? The truth is, all these prices that we see where credit cards are accepted, so if we disregard cash only places for a second, wherever, whether it's grocery stores, mom and pop shops, wherever, the fact is someone is hitting these fees. So if it's the merchant who's hitting, let's say, around 3% in fees, then maybe, just maybe, it makes sense for them to increase everything by 3% so that they're still getting what they need. But then for us as consumers, if we use credit cards, for example, the Chase Sapphire Reserve, and you go out to dine and you get 3 times points, let's say that's 3% cash value just for this example, then that 3% that was upcharged, we're getting that 3% back, so it's negated. What this means is if you're using cash or debit, unfortunately, you are burning cash by default because the game is not there for those folks that are not spending on credit. It's basically saying that if you don't use credit now it's a problem. And so if you're not financially disciplined, of course, don't get that credit card because it's better to spend that extra surcharge of 2 or 3%, which you don't know is actually there, but might as well spend that instead of getting into debt, which could be years and years of debt, 30% a year, et cetera, et cetera. Your credit score is gone and you can't make more money from other investments by leveraging your money and so much more. So the point is, if you can avoid it, don't spend with cash or debit. But if you want to go every day and actually not feel that maybe you are burning that cash, then credit is the best way to keep spending your money because it's the only way to almost succeed or sustain this type of game. If you come to the end, thank you so much. It really means a lot to me. Leave that like, comment, subscribe. You know how it is. But yeah, I'll see you soon enough.